Good morning, everyone. Thanks for joining us today. Welcome to the Prophecy Half-Year Results Investor Conference Call. All attendees are now in listen-only mode. On the call today, we've got Prophecy CEO Brad Thomas. I'll pass you across in a moment to Brad to kick off our discussion of the company's half-year results. Today, we'll have a presentation followed by an opportunity for Q&A. If you would like to ask a question during the call, please type it in the Q&A panel within the Zoom app. So to kick things off, I'll hand over now to Prophecy CEO Brad Thomas. Go ahead, Brad.
Thanks, Tim. Thanks, everyone, for joining. Great to be here and really looking forward to not just sharing our results, but having a chat and answering some questions at the end. So I think many of you have probably seen the standard slides that we do and have done for the last few years. So there's a lot of information in the slide deck that I won't probably go into detail on, but I want to talk around what we're seeing and experiencing in the market, and just generally some feedback on how we're faring globally as a business that does operate in a truly global manner. So let's kick into the presentation. So I think one of the things I will call out is in the last year we have grown our headcount pretty substantially. We're now up over 110 employees, and we have a number of open roles that we are looking at the moment. And I think one of the things that I will say generally about the economy is staffing and hiring and retaining staff over the last 12 months has been an absolute roller coaster. So we've seen very strong wages growth 6 to 9 months ago. Pretty much anyone could walk out the door and get 30-40% more on their base salary, particularly in a technical role. And then more recently, in the last few months, we've seen massive layoffs from a number of tech companies globally and locally here in Australia. We're now getting to the point where I'm getting developers approaching us about if we've got any open roles. So I think the whole environment for hiring and staffing in technology businesses has changed very significantly over the last 12 months. And I like to think that we're approaching something that's much closer to normal than from a few years ago than what it has been in the last 12 months. Having said that, we've continued to increase our team members globally. I'll talk a little bit more about Manila in a few minutes, but it's been a very successful offshoring development for us. Obviously, all our R&D is done here in Australia, in Adelaide and Sydney, although we do have some developers in Manila as well. Most of our technical support, training, some other back office resources are in Manila. We have a growing team in the UK selling into the European and Middle Eastern markets and somewhat into Africa. And obviously, Denver still continues to be our largest sales organization for the company. But we do see opportunity everywhere in all of the markets that we operate in. We're going to continue to invest judiciously, particularly in sales and marketing resources over the next 12 months. So we've got something like 4,200 customers around the globe. There's about 4,000 of those are Snare customers and around 200 are eMic customers. And we'll talk more about the makeup of those customers as we go forward and what we're seeing in the market. Typically, I also get asked for general comments on the global market. And as an economist, I'm a pretty good sales guy. But the one thing I will say that we've seen consistently across the market when selling to large enterprise and government is that the sales process has certainly become extended in the last 6 to 12 months. There are very many more people involved in that sales process, particularly on the customer side. More people that you need to convince to say yes and to agree to buy. The process and the rigor that vendors are being scrutinized by has increased. There's certainly a huge amount of attention on security, data protection, privacy, how we a good vendor supplier in the global supply chain, how we're going to work in with our customers' security policies and whether there are any gaps. So my comment generally on the economy is that large enterprise large customers, particularly in the corporate segment, and government obviously needs to continue to do business. There's very much a focus on saving money, reducing operational costs. The sales process has become extended and longer and more complex. The requirements placed on vendors like us, particularly smaller companies, becoming more complex and more onerous. A great example of that is we typically get a security questionnaire from the companies that we're doing business with, and that can range from anything to 300 to 700 individual questions that need to be answered. And they're not yes, no, multiple choice questions. They're, answer with a paragraph, show me your policy, show me your procedures, prove to me that these things are in place. And that would be fine too if all of those questionnaires were the same, but of course they're not. So everyone is slightly different, requires a slightly different answer. So it does add a pretty substantial overhead to our sales process. But having said that, we still continue to be successful despite what I would call the complexity and the uncertainty in global markets generally. So let's move on. Corporate snapshot. I think the only thing I will talk about here is that while we've had some change in the institutional investors in the business over the last 6 to 9 months, we're still pretty much at a third. A third is retail investors, about a third is institutional investors, and the rest are either current or previous executives or directors of the business, significant insiders. And I have to say that from a valuation perspective, I think we're pretty good buying at the moment. That's just my opinion. But we'll talk about why I think that's the case as we move forward through the presentation. I won't talk about the other details yet. We'll wait till we get to this slide. So let's quickly recap the first half. And there's a lot to go through here. And I also want to give some insight into where we're at the point of being at the end of February. So the one thing I will say is the great outcome for the first half is we had record revenue for the business. So just over 9 million in recognized revenue. And while I don't like to give guidance, and I don't give guidance, I think that we're looking for a better than $20 million revenue performance for the full year, which again would be significantly record revenue for the group, up from about $16.4 million last year, which was a previous record. So I think from a revenue perspective, I'm pretty pleased with the result we achieved in the first half. I think particularly considering both the pressures on our own expenses as well as the difficulties of the complexity of the market globally that we're selling into. We continue to be focused on the large enterprise and government segment, and that's where most of our customers are coming from. As you can see from some of the logos there, there's some great organisations doing business with the Australian Department of Defence, the Kiwi government with ACC, there's very large health services organisations like Nations Benefit, people like LeasePlan in the financial services, they're out of the UK, and globally Hawaiian Electric Utilities in the US, and Amica is an insurance, significant insurance company in the US. And that's consistent across both SNARE and EMITE. We're focused on large enterprise and government, and obviously that segment continues to need to grow, expand, service their customer base as well as staying cyber secure. So I think we're very pleased that we are focused on large enterprise with the uncertainty over the last 2 or 3 years in global markets. EMITE continues to do very well. Again, record revenue for EMITE, record invoicing. We continue to grow ARR. That's up to 13.7 now. And I think what you'll see out of EMITE is ARR in the revenue in the vicinity of 10 or 11 million, maybe a little bit more by the end of the financial year. The other great success story in the first half was the continuation of our subscription model for Snare. So, it's only just over a year ago that we introduced subscription. We sold $2.2 million in new Snare sales, of which nearly 80% of that was subscription in the first half. And this does have an impact on us from both an invoicing and a cash flow and a revenue recognition perspective. So in that change from perpetual to subscription, if I can give you an example, if I'd sold a $100,000 license to a customer in the perpetual model, then obviously I invoice that whole $100,000 up front. I collect the money, I put it in the bank. So that's great for cash flow. But I also get to recognize that in the P&L pretty much at the time that we generate the invoice. So there is a substantial boost to the P&L in the short term for a perpetual license model. But when you flip that into a subscription, even though we increased the price of Snare at the time that we did that a year ago, that $100,000 perpetual license sale really translates into about a $40,000 annual subscription, which continues on. So $40,000 per annum rather than $100,000 upfront and then $20,000 each year after that. So the invoicing that we see from Snare and the sales totals we see from Snare have been impacted by that transition to subscription. But from a long-term viability and growth perspective, you can't beat subscription. If you've been with us for a few years, you would have seen us go through that transition with the Emite business. Emite's come through the other side and is now generating great growth and continuing to compound as we add new and larger customers. And we fully expect the Snare business to do exactly the same over the next year or two. But it does have a short-term impact on both the amount that we invoice, the amount that we collect as cash, and what we can take to the P&L from a revenue rec perspective. Obviously, if you're selling a subscription, you can only take that revenue to the P&L on a monthly basis. So again, that $40,000 example that I gave, we're taking, what's 40,000 divided by 12? $6,000 per month to the P&L. So it gets taken to the P&L over time. So there is an impact to the P&L and to the cash flow from that change to subscription, but it's certainly much better for the business in the long term. And I'll talk more about where we're at from those things as we go forward. In fact, I think probably one of the things I will talk about right now is that even though we have gone through that, are going through that transition, as at the end of February, our invoicing for this year, so what we've actually invoiced our customers, is in front of where we were at the same stage last year. So we're just under $15 million invoiced for the full year across both Snare and Emite, which is about $500,000 up on where we were at the same period, at the same period last year. So that's very positive. So even though you're seeing impacts on from the subscription, we're covering that pretty well by both, continuing to sell Snare as well as the ongoing invoicing and growth in Emite. I think the other thing that we keep doing is we do continue to add to our ARR through both Snare and Emite subscriptions. It's probably been a little quieter on the Emite side, and I think primarily that's due to our major partner Genesis having two significant restructures and rounds of layoffs in the last 6 months. There were one in October and another one in January. So that has certainly made that partnership a little bit unsettled from a sales perspective. Still very strong. We still have a very strong pipeline. We still engage very deeply, but it's certainly put them off their game a little bit in the last 6 months. And we expect that to continue to pick up over the rest of this fiscal. We have some very significant opportunities in the pipeline with Emite, both locally and in the US and in the UK. I think the other thing that always comes up is the cash position, and as at the end of February, cash was 10.2 million. So it's come up even from the amount that we announced at the half. The last 4 or 5 months, we've certainly been cash flow positive. there's been a significant, front loading of a number of our expenses that we pay for in our Q1, fiscal Q1, that where we're paying annual subscriptions and things of that nature. So that comes out early in H1, and a lot of our large invoicing happens early in H2. So, for instance, the Humana agreement was just invoiced in January, and that's a $1.45 million invoice that's sent out in January. And when you look at our combined cash and receivables position, we're right back up to where we were at the end of last fiscal, and I fully expect the business to be cash flow positive by the end of the year. That's always been a question that everyone is asking. And then from a pipeline perspective, we have very substantial pipeline opportunities for both Snare and eMight. There are a number of things that we will be announcing shortly around customer acquisition, both locally and in international markets. And we have a strong and growing pipeline. We continue to add new pipeline opportunities every single month. We're converting these pipeline numbers are raw, so they're not weighted, and we typically convert around 35% of raw pipe into sales. That's been consistent in my time in the business, and we're expecting to finish the year very strong and continue to make sales across the board for both Snare and eMight. The one thing I will call out is that I've been talking about some big US defense deals for probably about 18 months now. Some of those have gone away. That we're involved in 9 bids there. 2 of those have either been awarded or been withdrawn. One was awarded and we weren't successful. Another was withdrawn. So we're still in 7 bids, but those bids are not included in that Snare pipeline number, simply because the numbers are too variable, and also they can be too large, and it really throws out what is the normal pipeline for the business. So I haven't included those 7 large defense bids in the US in that Snare pipeline number. Looking at the numbers, as I said, $9 million record revenue, up from $7.5 million at the same period last year. The loss was really driven by a number of expenditure items, and I will talk about that because there was some significant changes in expenditure in the first half. So there were really 3 things that drove the increase in our expense line. One which is expected was the increase in our hosting costs as we add more usage and more customers onto the eMight platform. So that number has increased by about 20%. The other major project that we did in the last year was we transitioned all of our internal IT into Oracle Cloud. So we're really moving all of our hardware and CapEx based systems into cloud-based systems and into OpEx. So there is an increase there. But the single largest significant increase in our expenditure, in our expense line versus what we announced at the end of the last fiscal year is really foreign exchange. So at the end of June 2022, we had a unrealized foreign exchange gain on the books of about $450,000, and on the books at this point, at the end of December, we had an unrealized foreign exchange loss of around $640,000. So there's $1 million turnaround in our expense position, really just from unrealized foreign exchange losses and gains. So that's really the thing that's driven the accounting loss to a large extent for this half. And as it always seems to be at the end of a reporting period, the foreign exchange rate goes the wrong direction, and we end up with a nasty number on the P&L. I'm happy to say it looks like the Aussie dollar is softening a little bit, and that helps us a lot because 80% of our revenue is generated in either US dollars or in pounds or euro. So the a softer exchange rate really makes a significant difference to us. From a cash flow perspective, I did talk about that a little bit at the start. Again, with the front loading of our expenses and the back end loading of our large invoicing, I think I'm certain that that's going to correct for this year, and I expect us to be cash flow positive for the year. Cash balance at the half was 9.7. It's now up to 10.2 and moving in the right direction. Our receivables are just under $5 million at the moment. We expect to collect the vast majority of that in the next, probably in the next 14 days, most of it because it was invoiced in January. So I expect our cash balance will improve again for the quarter. And our invoicing, at the end of December, our invoicing was 9 million. It's now at 14.9 million. So, in 2 months, we've invoiced nearly $5 million worth of receipts. So it just goes to show the seasonal nature of the large invoices that we do for these customers. Because typically our model for Snare and for eMite is to invoice annually in advance. We do have others that are on either monthly or usage-based invoicing, but on the eMite side, probably 70% of our customer base is invoiced annually in advance, and that helps us from a cash flow perspective once we've invoiced those, because we collect all the money up front. And again, we have no debt, and that continues and has been the case the whole time that I've been at the business. So a lot to take in there. I'm sure there'll be questions at the end, but we can come back and cover those. So I might move on because there's some other things we want to talk about. I think one of the things we did talk about at the AGM, and I want to reiterate, is that we've established our own subsidiary in the Philippines, and while there were some setup costs for that, we expect that bringing that in-house delivers a couple of things for us. One, a much happier workforce and a much more flexible approach to business in the Philippines, enabling people to work remotely and really just give our team members the environment that they want to work in. But it also will generate around about $500,000 per annum in savings for us in having that team in-house versus through a third-party outsourcer. So we're constantly looking for ways to continue to minimize expenditure and maximize both our cash flow and our profitability. Even things like simply like our head office in Adelaide, we've just this week we've moved offices in Adelaide, and that will give us around about $100,000 per annum saving as well. So we're always looking for ways to ensure that we're being careful with our money and minimizing our expenses and focusing them mostly on the areas where we want to expand the business. Most of you have seen this timeline before. I'm not going to spend too much time going into it. I think the important things here are, a year ago, we signed our largest SaaS customer, which is Humana in the States. We invoiced them in January 2022, and we've just invoiced them for their second year of their 3-year contract with us in January this year. So that's a $1.45 million annual subscription, US dollars, for Humana. We do have other opportunities in the pipeline right now that are larger than Humana, which we are pursuing very vigorously. They may not come to fruition for this fiscal, but we have very substantial opportunities with very large customers going forward. And I think one of the other things we will talk about is when I get to the slide, we'll talk more about our defense strategy and how that's playing out and where we're seeing success from that. I talked about the large opportunities in the US, but I want to talk more about what we're achieving in the UK and more generally as part of Team Defence Australia right now. I think the other thing I do like to call out on this slide is the quality of the logos that we have. We're very much focused on large enterprise, government, defence and military segments, and we continue to be successful in signing some of the largest companies in the world to our software, both directly and through some of our significant partners. So when we talk about the markets that we are addressing, I don't want to spend too much time here, but I think one of the things that I want to call out with from the eMite side is that today the vast majority of our customers come from either the Genesis or the Amazon Connect ecosystems. And what does that mean? Well, it means that for every customer that's trying to deliver customer service or a great customer experience, trying to make sales to their existing customer base or to new prospects, or to retain their customers, to provide them levels of service, to ensure that they're getting the support that they need, everyone has a contact center, and the contact center is kind of one of the key pillars in delivering customer experience. And there are companies like Genesis and Amazon that are two of the largest players in that cloud contact center market, but there are many others, and they are companies like Five9, 8x8, Nice by InContact, Twilio, TalkDesk. There are any number of them. Zoom are getting into that space now. Microsoft is getting into that space. Google has announced it's moving into this space. Salesforce has a relationship with Amazon to provide their own contact center solution. So this is a growing and expanding market space. And eMite has a great opportunity to continue to expand into that space. And we are doing some significant product development right now that will enable us to do that in the very short term. Now, I'm not going to preempt too much, but there are announcements coming relatively soon that will talk about how we are going to address this market and what the market opportunity for us is going forward. Because eMite is often thought of as a dashboarding or a reporting product, but what it really is a data product. So it's about, and Snare is the same, it's about collecting data from wherever it sits, collecting it, correlating it, aggregating it, normalizing it, parsing it, running algorithms, reports, alerts over the top of that data, and then making it available for analysis. So our two products are very similar, even though the way we go about delivering those is very different because the segments are different. But there's still very substantial upside in that CX market space with eMite. The complexity of the data landscape is only increasing. And I think if you look at what a typical enterprise customer is using in their environment to deliver customer experience, sure, they have the contact center, but they also have an IVR, they have chat, they have chat bots, they have a CRM system, they have a ticketing system, they have a workforce management system, they have a survey system, they have a transcription system, they have a customer sentiment system. So there's 10 different applications or tools that they're currently using to deliver CX, and they are completely disconnected. The data is in different formats. It's not joined up. It's not collectible easily into a single platform. And that's what eMite does. It collects all that data, it normalizes it. We enable you to run custom KPIs and metrics and analysis over it, and then visualize it at the end. So the visualization is actually just the shiny bit that everyone sees, and it's the data collection, aggregation, and normalization that is the power. And the same with Snare. Snare just does exactly the same thing using different technology in the security domain. And as we're seeing with US federal government, with increasing regulation around cybersecurity, around new executive orders out of the White House, the M2131 logging mandates for government in the US, the SEC's reporting, cyber breach reporting regulation, the critical infrastructure cyber reporting regulation, same here in Australia with the critical infrastructure, and the increase in cyber oversight from the government, particularly in the wake of things like the the Optus and the Medibank data breaches. We're seeing the same thing in the UK, and in most mature markets, there is a heightened awareness around cybersecurity, but also a mandate to improve, particularly the security analytics, to find out who got in, how did they get in, what did they see, what did they take, answer the how bad is it question. You can't do that with perimeter security. You've got to do that with security analytics, and that's what we enable our customers to do. And we enable them to do it at an affordable price with a very robust solution. So let's keep moving on. The key on eMight that I want you to be looking at going forward is looking out for the new product announcements around what we're doing around data collection and being able to expand our coverage into the CX market space. We continue to be successful with some of the largest companies in the world as the complexity of their data and the desire for them to understand that becomes more sophisticated. We continue to focus on large enterprise. We're very successful in segments like health, in insurance, in utilities, and that's where we continue to focus. But I'm really excited about some of the product announcements we've got coming out very shortly. So keep your eyes open for that. We continue to focus on the same things that we've been focusing on. There's really no change of strategy for us. Product innovation, I've already talked about, expanding our revenue streams by moving into adjacent market segments, not just relying on Genesis and Amazon, but being able to work with more and new partners in this space will certainly open new opportunities and new revenue streams for us. We're still at the start of the migration of customers to the cloud. I think there's 5 to 10 years of continued migrations to the cloud. We're really only now, after 5 years in this market, starting to see very large customers and government starting to move to the cloud. And many of those will take years to get there because of the complexity of their environments. So we're seeing a very strong future opportunity for us as that industry and market trend continues over the next 5 to 10 plus years. Along with that product innovation, we continue to focus on the new partnerships. We talked about some of these other vendors, so stay tuned for that. And then I think the other thing to be aware of with the eMight business is it is absolutely a channel-based business, and we sell through those big vendor partnerships, Genesis and Amazon, but also through their resellers and the implementation partners. So people like Teletech and Converge One, and here in Australia, both Telstra and Optus are partners for us. NTT, Orange Business Systems in Europe. There's a number of different ways that we find our customers through those partnerships, and we'll continue to expand those partnerships as well as expand our sales organisation to take advantage of the opportunities as we see them globally. And really, all it comes down to is us continuing to acquire new customers, new ARR, and new subscriptions onto the eMight business and continue to grow that. Snare, I'll talk a little bit more about that. I did allude to it at the start. What we're seeing from our customers is the requirement for regulatory compliance, whether that's PCI DSS. In fact, there's a new version 4 standard out in the market now, whether it's NIST, the ISO standards, HIPAA, NERC in the energy sector in the States, SOX. All of these compliance standards are becoming more and more onerous. The penalties for non-compliance are greater. And on top of that, there's a whole range of additional regulation, either from the SEC, from other regulators, market regulators, like government, new executive orders, new critical infrastructure mandates. And the whole point of Snare is to abstract the complexity from our customers and enable them to meet those compliance requirements and be more secure without huge cost, huge complexity, or a huge staff to run the system. One of the things that does drive our sales is there are not enough cybersecurity professionals globally to go around, and our customers are looking for a solution that is easy to deploy, easy to maintain and tune, and is affordable. And that's a very strong value proposition for us at the moment, particularly as companies are looking to save money and save time and reduce the costs of being secure. We can help them do that at a very affordable price in a very robust way. So one of the other things that I often see is people think that Snare is a single product, whereas Snare is actually a suite of products. The vast majority of our customers today still have just the endpoint agents, whereas we're now selling both the enterprise tools as well as the Snare Central centralized log management platform. And I'll talk about a single opportunity once I get to the defense slide. That gives you can help give you an understanding what the opportunity looks like for Snare. But we continue to focus on our existing customer base. We are transitioning as many of those to subscription as we can. The vast majority of the subscription sales that we've made to date have been net new customers, new prospects. We're working through a program now to try and move our existing customer base to both upsell them and move them across to subscription. And if I sold, one copy of Snare Central to every customer that doesn't have one, that's around about a $30 million revenue opportunity for me. So we're quite focused on trying to get all of our technology platform in the hands of our customers and just not a single product. And again, we have a very strong value proposition at the moment where our customers are trying to reduce the cost of their very expensive SIM systems or reduce the amount of headcount, expensive cybersecurity skilled headcount that they're using to run those systems. So we have a very strong value prop, and really our job is just to make sure that both direct and through our partners, we're getting engaged with the right prospects to be successful with a really strong solution in the market. So one of the areas I do want to talk about is defense and military. I've already talked a little bit about the US, but we've also been incredibly successful in the UK. In fact, the single largest sale that we've done in this half so far, on the back of doing a very substantial deal with the Royal Navy last year. In fact, that was our largest sale last year for Snare, was the Royal Navy. There was over $700,000 of Snare for the Royal Navy, and that was done through our partnership with Fujitsu. We've just done another deal in the UK with the Royal Air Force, and that was in excess of $550,000 into the RAF. And we have a pretty substantial pipeline of opportunity, both with the UK military as well as a number of other military defence organisations around the world, including here in Australia. And it's by leveraging those big partnerships, whether it's Fujitsu or Atos or Capgemini in the UK, or Fujitsu or the telcos here in Australia, or specialised partners like Vambrace or Frontier or Jescal in the US, that's how we get into these big deals and are successful in winning them. So it's that combination of the partner strategy as well as building products specifically to meet the requirements for defence is how we will continue to be successful. And I'll talk a little bit about what we're doing next week in Japan in the next slide. The other strategies that we've got, of course, are continue to upsell into our existing base and completing that transition to the subscription model, which should build us a very substantial compounding revenue stream over the next 12 to 24 months. Finally, on the defence piece, the Snare product is recognised by defence as a very significant piece of sovereign capability in the security analytics market. It has some specific attributes that make it exactly right for the defence market segment. And as a result, we are part of Team Defence Australia, attending the DSEI event in Japan, basically next week. So we'll be exhibiting there as part of Team Defence Australia. We'll be there with our partner JTC in Japan. So we have a dedicated partner for Snare selling into the Japanese market now. Snare actually caters for Japanese language characters as well. So we're starting to feel very good about that market opportunity, and we think there's very significant upside for us in Japan. We've got a number of customers there now, but it's really just a small beachhead. We're looking to expand that pretty substantially, as well as continue to sell into both the AUKUS and the Five Eyes and the Quad countries from a security perspective as a trusted vendor in the global defence supply chain. So again, all of these actions and events really help build credibility in the value of the Snare product, particularly in that defence segment. And we're super proud to be part of Team Defence Australia and look forward to some great results coming out of that over the next few months. So I think to sum up, operationally and strategically, I'm very happy where we are at the moment. We continue to be focused on product innovation for both Snare and eMite. I talked about how we're going to be able to address new market opportunities with eMite very shortly, and that opens up exciting new doors for that product and new revenue streams and new partnerships. On the Snare side, we have a strong roadmap of new functionality in the product, which will help us, again, add more value to our customers and capture more of their share of wallet, both for those existing customers and for net new. We want to continue to expand our sales organization and our marketing capability globally. We're selling into something like 60 countries globally today out of our three sales regions. We've got Asia Pac, the Americas, and Europe, and I see us expanding all of those going forward as we continue to grow the revenue. We're obviously looking at our own operational efficiency, and things like moving the Manila team in-house will save us $500,000 in expenditure each year, and we are really looking to make sure we stay as operationally efficient as we can. We're also investing in our own customer experience in the world of subscription revenue. Retention of customers is just as important as acquisition. So we continue to invest in both our support, training, and systems and tools to enable our customers to stay with us for longer, and increase the customer lifetime value from each of our customers in this subscription world. And then finally, we want to continue to drive subscription revenue across both products, and continue to grow organically over the next few years, and grow our revenue to the point where we're starting to get the attention of larger investors, and really hope to drive the share price for our shareholders very significantly over the next 2 to 3 years. So to sum up, I think the reasons why you would want to continue to invest in Prophecy remain the same. We have a number of diverse revenue streams in global markets. We have great customers and sticky business. We've got very large addressable markets, and we have very strong products with great applicability to both large enterprise and government. And we have very strong pipelines and market trends that are supporting the growth of the business. So from there, Tim, I might wrap up and we can go to questions.
Thanks very much, Brad. And there's been several questions come in, so let's hop straight in. A few of these topics, Brad, you did touch on them to varying degrees, but probably a good opportunity for us to go a little bit deeper on the different pieces. So one that's come in is asking for more colour on the cash burn in the first half of the financial year, and what impacted that most strongly. The comments made that Prophecy historically didn't have this level of cash burn, and the question is, what should we expect for the business on this metric in the second half of the financial year, given your comment around increased hiring and movement in the pipeline?
I think, as I said before, Tim, a lot of that cash burn is a number of things that we do in the business, whether it's our internal systems or our hosting costs, or in fact, the staff costs in the first half have been impacted pretty significantly with just the way the market has been. And as we expand, as we add more customers, as we add more staff, then obviously our systems and tooling costs increases as well. So yes, there's been some, there's also been some setup costs for bringing the Manila business in-house, as well as some, increased costs in setting up a number of marketing systems. So, I think, yes, there was some, significant expenditure in the first half, but that's mostly done now. In fact, the last 4 or 5 months, 4 months, we've been cash flow positive, and I expect that the business will be cash flow positive for the year, as I mentioned before. I think it was really just a matter of us making some investments in some things that we needed to do to get the business to the next level. I wish it was just a nice linear equation where, you add $1 of revenue and you add, 70 cents of expenditure, and you just do that forever. But it never seems to work that way. There's always things where you've got to do some investment ahead of the revenue curve to get to that next level. And I think that's really what happened in the first half. Certainly there were some recruitment costs in there. There was certainly some increased expenditure from our existing staff as salaries were going crazy. But I think that was quite abnormal, really, and I expect it to be a little bit smoother as we go through the rest of the year. And I do expect us to be cash flow positive by the end of the year.
Okay, thanks, Brad. And so on a statutory basis, I can understand it might differ somewhat in terms of the timing. I think it's impressive that you're able to put your flag in the ground saying that you'll be cash flow positive this year. A question's been asked about the plan to return to profitability at on an income statement basis, and can you talk to the timeline of when Prophecy might be looking to achieve this?
Well, we honestly, we're looking for that every year. Certainly my board doesn't let me off the hook and give me a free run on not being profitable. And obviously our intention and our desire is to be profitable, at least an EBITDA level. There's a whole range of accounting things that come into that mix that affect the P&L, but generally I like to keep it pretty simple. Is it, are we generating cash? Are we collecting more cash than we spend? And once you take out amortization and depreciation, not that we've got much depreciation now because we run a pretty clean expense line. Nothing is capitalized in our development, for example. It's all expensed. But you take out amortization and forex, and for me, it's again, have we got more revenue than we had expenditure? And that's really what we're looking for. And I'm looking for that every year. I got to say, the last 3 years have been particularly tough, given the global macroeconomic environment. It's been very challenging, running a global business, particularly a small global business in that kind of environment. But I think realistically, we've come through incredibly well. We're in a very strong position. We continue to grow. We will generate cash this year, just like we did last year. So I think we're, compared to many of our peers, we don't need cash. We don't need to raise. I think we're in a significantly stronger position than many others in the market space. And I'm not sure that that's valued by the market as much as it should be.
Yeah, agreed. You've just answered another question, Brad, which was the question was asked if R&D is fully expensed rather than capitalized. So you've just
and it is.
fully expensed. Yep.
Yeah.
Good point. So just changing gears slightly, the question is about asking for more color on your customer acquisition point. Are you acquiring some customers from a competitor across Snare or Emite?
Well, that's a super broad question, and the answer, of course, is yes, right? But as with all of these things, there's no single answer. So in the Emite space, we're acquiring customers as they transition to the cloud, or in some cases, after they have transitioned to the cloud, at which point they realize they can't actually manage that environment effectively and they need to do something different. Or they've got, as I alluded to before, they've got too many disconnected applications and they can't make sense of the data in a meaningful way to actually run that part of the business. So customers are moving to the cloud from somewhere, and there's a very large install base of on-premise legacy platforms and customers that have been running those platforms for 20 years. So yeah, everyone's coming from somewhere. There are very few net new, and the net new in that tend to be smaller, which is not the segment that we're chasing anymore. You know, five years ago, we were chasing that segment because it was the only segment that existed. But now it's really, for us, it's 500 seats and up for the eMite product, so a 500-seat contact center and up. And that's a pretty big environment. You know, that's, I had an example in Australia. You know, the largest health fund in Australia is probably that size. You know, if I look at Humana, that's a 25,000-seat contact center. The only one of the similar size in Australia is Services Australia, and that's also a customer of ours. You know, the big banks are around about 3,500 or 4,000 seats, and we've got a number of those in the States that are bigger than that. Same in Europe. So it's really that large enterprise segment, and they've come from somewhere. Now, they might have come from Cisco or Avaya, or they may have come from one of the Genesis legacy platforms, and they've migrated to the Genesis Cloud product. So yeah, we are picking up customers from a competitor, but in many cases, those legacy platforms have very poor reporting to start off with, and you know, what we're giving them is a whole new experience and a whole new ability that they've never had before. So it's not really the fact that we're picking up from a competitor. It's more the fact that they move to the cloud, and then they need the best solution to manage a complex environment with, and we're one of the strongest options in that space.
Yep, sounds good. Thanks, Brad. It's coming at the customer acquisition question from a different angle. The comment made by another attendee that the sales pipeline looks pretty similar to what it looked like a year ago. And can you comment on the new sales staff that have come into the business and the impact that they might be able to have on pushing that further?
Yeah, look, we've definitely been trying to add and have been adding new sales staff. I have to say that's been a slower process than I would have liked. And finding good quality people that can have an impact, that fit in with the culture of the business at a price that's affordable for a relatively small business like us, but who have also got enterprise selling skills that can sell to, you know, the largest companies in the world, or the largest government agencies, or work with some of the largest system integrators in the world. It's absolutely a challenge. You know, we had a very good sales rep here in Canberra, and you know, she got poached from us at a very significant increase to her, you know, overall salary package, and we just simply couldn't compete with it. And in some of those market segments in particular, you know, it does take 6 to 12 months for a sales rep to become effective. You've got to establish relationships, you've got to understand the product, the value proposition. So it's tricky. It's not like, you know, oh yeah, I need 3 more salespeople, just go to the salesperson store and grab 3. It's not, doesn't work that way, unfortunately. So we're very picky about who we bring in. We have brought in a number of new folk who are still ramping up, but I expect that they'll all be successful over the next 6 months or so. And we'll continue to, as we find good people, we're almost always looking for good people. You know, as we find good people, we'll bring them into the business because we've got the opportunity for them to address. We still continue to be capacity constrained rather than opportunity constrained, and really the pipeline hasn't changed really in scope or size, is because, you know, at this point, you know, we can only really handle so much opportunity effectively, and if we got more opportunity than in the pipeline, that we simply can't address it. We can't effectively manage an enterprise sales process or engage with an enterprise level partner unless we bring more capacity into the business.
Yeah, that makes sense. And so just to follow on from that one, if that capacity constraint exists, has the increase in staff costs come to some extent from pay increases to existing staff rather than bringing on extra heads?
Again, yes to all of the above. So the last 12 months have been particularly challenging, particularly for technical staff. So, either hiring new technical staff or retaining existing technical staff did come at a cost. So there's definitely some increase from that aspect. As we bring in more bigger, complex customers, we have to scale our support organisation and our consulting organisation. So again, they're more technical resources. While we do as much as we can offshore in Manila, and we've also had to hire some folks in the US, which is why we got over 30 people in the US now. The fact that our highly skilled, expensive technical resource in US dollars looks absolutely terrible on the P&L of an Australian company when the dollar's sitting at 65 or 66 cents. So we've got all those challenges, but we just need to continue to be very focused on making sure that we're filling up the roster appropriately to either retain the existing customer base and expand them, or to acquire net new. And really, that's what we're doing. So, yes, it costs more to retain and keep the technical staff. It's really expensive and difficult to find quality salespeople globally. It's tough everywhere, and trying to do it off a 100-person base in 5 different countries is definitely challenging.
Yep, makes sense. So it's just another question on the cost base and the support infrastructure. You mentioned the Philippines just in that answer, Brad. The question is, can you explain a bit more about the Philippine subsidiary? And questions asked, why would an outsourcing company let you take part of their business and stop using them? Is there something that they got out of that transaction as well?
No, when we set up the original contract, there was an out clause. We set that up nearly 6 years ago, and we had one person who's still with us, by the way. One of the reasons why I really like the Philippine team. We've had very little turnover out of the Philippines. We're a good employer. But when we set up that contract, it had we can get out on 3 months' notice, and if the team want to join us, then they're allowed to join us at the end of that three-month period, and that's what we did. I'm sure that the outsourcer didn't like the fact that we did it, but they'd had a very good customer for 5 years, and we grew with them pretty extensively until the point where it didn't make sense for us to continue to do business in that manner.
Yeah. Okay. A few questions on Snare. The questions asked: would Snare Central benefit each and every Snare customer if they chose to upgrade to it?
Wow. Yes. There's always a caveat there, right? In that we do have a number of customers that only have a small number of Snare agents monitoring their critical systems. Now, the problem is that those customers are doing the bare minimum to meet compliance requirements, and many of those customers should be collecting, security data from many more systems than they are. And generally they don't do that because it's either too expensive, or they don't have the staff to do it, or the tooling that's required. The other solutions in the marketplace are very, very expensive, or that it's very uncertain from a budget perspective because they get charged based on how much data they ingest or how fast they ingest that data. We've got any number of examples of customers that get a quote for several $100,000 for their annual licensing costs from some of the big vendors in the market, and then get a bill for $2 million. So our value is to give those customers budget certainty, but it's also to make it affordable for them to be able to monitor all of the systems that they need to monitor. And as soon as you start doing that, you need alerting, you need reporting, you need forensic storage. You need to be able to manage the security policy of the agents that you've got deployed on your endpoint systems. So yes, every customer that we've got, unless they are super small, could use Snare Central. So, probably 85% of our customer base could, should, and at some point will have a Snare Central. I think the one thing I didn't talk about that I meant to talk about in the defence slide is that RAF deal that I talked to before. That was predominantly for Snare Centrals. That was 18 separate Snare Centrals for the Royal Air Force. So and we've got other customers like Gemalto, now part of Thales. They've got something like 27 Snare Centrals across their network across Europe. So we've got other customers that are running multiple Snare Centrals in high availability mode because they need to be certain that they're collecting and retaining the pristine log data that they're collecting for both compliance and forensics and potentially in case of any litigation. So there's a whole range of reasons why customers should be looking at Snare Central. We're getting much better at selling the whole stack. We're understanding what's driving our customers. So yeah, I see a huge future for Snare Central, and we continue to invest in product innovation in Snare Central, and that product's and platform's just getting better and better.
Cool, good stuff. On the Snare pipeline, can you comment on the track record that Snare has in terms of being part of the winning consortium on the large US federal deals? And another question asked: is there a timeline on those 7 potential contracts, or is the US government still delaying decision making?
Well, the 2 very big questions there. Let's get the easy one first. So, winning defence deals in the US Fed, we've got current relationships with pretty much every branch of the US military, whether that's the Navy, the Air Force, the Marines, NASA, Space Force, you name it. We've got a foothold in there somewhere, and we've typically got that with one of the major defence prime contractors. So whether that's Boeing or BAE or Lockheed or any one of the big defence contractors, and we continue to do business with people like that, like Northrop, for instance. We do a whole range of project work with them where they're securing particular research projects for the Defence Department, and that project might be stood up for 5 years, and we'll do the security and the monitoring for that. Then it gets torn down after that project closes. So yes, we've got relationships and a track record of doing business with the big defence primes. There are other vendors in that market space. IBM's got a very strong position there. We've got a great relationship with IBM, and we're pursuing a number of opportunities with IBM at the moment. Then we also have specialist partners in there as well. The Jeskils, the Frontiers, the Van Braces, the Fours. So we have a range of relationships. Have we pulled off the multi-million-dollar Snare sale in defence in the past? No, we haven't. But we weren't really chasing it either in a meaningful way. So I think we're well positioned. We've got some credibility in that market space. We've got credibility in other defence organisations around the world. We've got the right partnerships. We've got the right product. We have the right cost model. I think we will be successful. I think there is some challenges in the US government space at the moment, which I think most people can see from the outside looking in. I see most of the agencies still being funded on continuing resolutions as opposed to real budgets being released, but we're starting to see some of that happen. But yeah, I mean, as a US political analyst, I'm a pretty good sales guy. I wouldn't like to speculate what the US government is doing or not doing on any particular day. So completely outside our sphere of influence, we're still involved. We're still working with those partners. We're active. And if the budgets get released and the bids get awarded, I'm sure we're going to pick up our fair share, but that's just completely out of our control at the moment.
Yeah, well, there's a whole industry of beltway speculators about what will or won't happen. So I think you've probably got your hands full just trying to focus on the business. But
we really focus on execution. There's some interesting things that we're thinking about with some of our partners, but it's probably too early to talk about that at the moment. But there's some other things we can do that we're looking into at the minute. Try and get better visibility of the product at the right people in Washington.
Good stuff. Just on the snare sales model, the question's asked, what do you think the revenue opportunity is for moving perpetual snare subs over to annual subscriptions? It's probably a two-part question, so maybe that's the first part. What's the revenue opportunity moving them across?
So I think for our existing customer base, which is currently generating, let's call it $3.5 million in maintenance per annum. So that's the annual 20% of the initial license fee. Provided we retain 100% of that base, it's worth about 3.5 million Aussie per annum. Getting them across to a subscription when they've already paid for a perpetual is challenging. The way that we envisage doing that is as we release new product capability that will only be available as a subscription license, and we will give some level of credit for the perpetual license already paid to those customers. And that's going to be an ongoing process, both as we engage those customers over their life cycle, but also as we release new product capability. So I expect that's going to take a number of years for us to get through that customer base to get them to subscription. And I don't have, I have a screaming hurry to upsell those existing customers, but I don't have a screaming hurry to convert them to subscription. I think it's going to be case by case basis. For our net new, really everyone in the commercial market segment is going onto subscription. And there needs to be a very good reason for me to approve a perpetual license for a commercial customer at this point. Really, the only perpetual licenses we're selling at the moment are to military and government agencies that for whatever reason are unable to buy subscription. But we're also seeing that thawing as well. We're seeing some happy to go to subscription. So I think over the next 3 years, I think we'll move to an 80 or 90% subscription base, both existing and new.
Yeah, it's good to understand the outlook for converting existing clients across to the sub model, but yeah, that all makes sense. So a couple of EMITE questions. So with EMITE now close to break even, do you anticipate any increase to the product's cost base from here, or should margins continue to improve with new wins?
Yeah, a number of things happening there. Margins should continue to improve with new wins. We're currently working on about 85 points of gross margin on the EMITE product. Really, the only cost there is our hosting costs. The new product that I've alluded to in the presentation will help us increase that margin by reducing the amount of hosting that we need to host even the largest customers. So I expect that both margin improvement from reduction of COGS, as well as just simple leverage of bringing new revenue in on top of the existing. We're going to continue to invest in that business, but it should be profitable and will be profitable. Should be profitable going forward, and we should be able to continue to improve that ongoing now that we've got to a certain amount of scale. Yeah, so that's the plan for the EMITE business.
Cool, sounds good. Can you break out how much of EMITE's pipeline is with Genesis?
It's about 70% at the moment.
Yeah, cool. Okay. Another EMITE question. Any updates that you can share on opportunities with Optus as part of the MSA that we've announced?
Yeah, we're in the final procurement phases with a very large government agency in Canberra at the moment with Optus. I can't give you any more information than that right now. But we will announce that obviously as soon as that's completed. That's definitely this financial year deal, and it's a pretty significant one.
Good stuff. Just coming to our last couple of questions now. So if anyone else has any other things on their mind, please do pop it into the Q&A box and we'll address it. So when you say that you'll be cash flow positive by the end of the year, do you mean overall for FY23?
Yeah, overall for FY23.
Yeah, okay. Not just the exit run rate.
We're already cash flow positive at a run rate level, have been for the last 4 months.
Yeah, excellent. And another one that's come in, making the point that some listed tech companies get sort of material tax incentive refunds. Can you comment on Prophecy's eligibility for those bigger refunds?
Yeah, really the big area there is from the R&D incentive. We do claim the R&D incentive. We have claimed it for my entire time in the business. Last year that was actually a cash refund of about 425,000 off the top of my head, which we got paid in January, by the way. If we'd been paid in December, it would have been nicer for our cash position at the end of the reporting period, but tax office in their wisdom paid us in January. Yeah, we apply for the R&D incentive program every year, and any government grants that we can get that will help strengthen the company or offset any of our costs, we're absolutely focused on.
Good stuff. And in terms of letting people know what to expect announcement-wise, will you continue to update the market with business growth updates summarising recurring revenue shortly after the end of each quarter, as we have done?
Yeah, that's our plan. Yeah, that's definitely our plan. Yeah.
Good stuff. And probably more of an, I guess, industry question and your place in it. The comments made about Prophecy's stated objectives of being a relevant Australian software company. How do you view sort of at what level of revenue or other metrics would Prophecy say that we've achieved that goal of becoming a relevant Australian software company?
Well, I think my first kind of benchmark for the business that I was kind of hoping that we get to this year is that $25 million of revenue. I don't think we're going to get there this year. I think things have just been a little bit too uncertain globally. But 25 million is the first step, and then on to 50. I think at 50 million, with a reasonable multiple as opposed to the 2.5 times multiple we're trading at the moment. But realistically, SaaS business listed, you should be looking at 8 to 10 times multiple of ARR, let alone revenue. If we can get to 50 million at a 10 times, there's a $500 million market cap. I think that's eminently achievable over the next couple of years with the products we've got and the market opportunity we've got. We're very focused on that. And as you start to get to that level of revenue and market cap, then interest increases. You get onto other people's radar, and I think there's the opportunity for even more significant growth going forward from that. So that's really where we're focused. Next stop 50 million, folks. Yeah,
exciting opportunity. That's all the questions we've had for the moment. So on behalf of Prophecy, I'd really like to thank everyone for tuning in today. We really appreciate everyone joining us and for your continued interest in and support of the company. If you have a question that we didn't answer today, please reach out. Management will be happy to discuss it further offline. We'll also look to make the video recording of this session available online as well. We look forward to the opportunity to talk to everyone again. Brad, I might pass across to you now for any closing comments.
No, look, I think just reiterating, Tim, we're very happy to have folks on the call. I'm always open to any questions if you want to send them through. I think my email address was on the slide deck, so feel free to reach out. I am pretty busy flying around all over the world at the moment, so allow me some time zone slippage. But yeah, please feel free to reach out. We really do appreciate the support that our investors give us. I'm really excited about the future of the company, and so are all the people that work here. So hold the faith, stay with us. We are going to go great places.
Good stuff. Thanks, Brad. Thanks everyone for joining us. Catch you again soon. Cheers.
Thanks, Tim. Thanks, folks.